One of America's most critical strategic allies in the Middle East has made a bold and historic move that is quietly reshaping the entire global energy and financial landscape. After maintaining membership for nearly 6 decades, the United Arab Emirates officially walked away from OPEC, the powerful cartel that has controlled and influenced world oil prices since its founding in 1960. This departure, announced amid ongoing regional complexities and energy market pressures, was not a sudden emotional decision but the result of years of building tensions over production quotas, economic diversification goals, and shifting global alliances. At almost the exact same time, the UAE's central bank issued statements indicating that the country is seriously considering pricing its substantial oil exports in currencies other than the dominant US dollar. Major international media outlets including Reuters, the Financial Times, and Fortune reported these developments with clear confirmation, underscoring that this is not speculation or conspiracy theory but verifiable policy evolution with deep systemic consequences. Despite the significance of these events, a large portion of investors and market participants remain either unaware or fail to appreciate the profound mechanical implications for the international monetary order that has supported American economic supremacy for the past 50. This is far more than geopolitical theater or headline drama. It represents a fundamental shift in how capital flows across borders, how reserves are managed by nations, and how the architecture of global trade and finance operates at its core. To truly understand what is unfolding, it is essential to move beyond surface-level interpretations and examine the precise mechanics of the petrodollar system, its historical construction, the invisible pillars that have kept it standing strong, and the multiple fractures that are now widening simultaneously. Gold's remarkable price strength in recent times is not merely a reaction to temporary fear or uncertainty in the world. Rather, it embodies a deep, institutional-level comprehension of structural monetary risks, liquidity transformations, and long-term value preservation that most participants in equity and traditional financial markets have not yet fully processed or internalized. Let us begin with a detailed foundation, because any meaningful analysis of current developments requires a clear grasp of how the petrodollar arrangement came into existence and why it proved so enduring. In the early 1970s, the global economy faced one of its most severe shocks in modern history. The 1973 oil embargo imposed during the Yom Kippur War caused oil prices to surge dramatically, quadrupling almost overnight. This led to painful gasoline shortages, with vehicles lined up for blocks at pumps, double-digit inflation, economic stagnation, and widespread uncertainty that threatened to unravel the post-World War II prosperity in the West. Against this backdrop, U.S. Secretary of State Henry Kissinger undertook intensive diplomatic efforts, traveling to Saudi Arabia to negotiate what became one of the most consequential informal agreements in financial history. Signed in 1974, this was never a formal treaty with legal clauses, expiration dates, or public ratification. Instead, it functioned as a pragmatic handshake understanding between the United States and key Gulf producers, particularly Saudi Arabia, that fundamentally restructured the relationship between energy markets and global finance. This arrangement rested on 3 interconnected pillars that created a self-reinforcing cycle of dollar dominance. The first and most visible pillar was the requirement that international oil trade be priced, invoiced, and settled almost exclusively in U.S. dollars. Because energy is the lifeblood of every modern economy, powering factories, transportation, heating, and agriculture, virtually every country on the planet needed to purchase oil. To do so, they first had to acquire U.S. dollars through exports, borrowing, or currency exchanges. This generated a constant, structural, and inelastic demand for the dollar that existed independently of whether American stocks, bonds, or economic policies looked attractive at any given moment. The demand was tied directly to the physical need for energy itself, creating what economists describe as an exorbitant privilege for the United States. This privilege enabled America to import goods and services more cheaply than other nations, finance large trade deficits without immediate currency collapse, and maintain lower interest rates than its fiscal fundamentals might otherwise allow. The second pillar involved the recycling of these petrodollars back into the American financial system. Oil exporting countries, flush with massive revenues from higher prices, channeled billions of these newly acquired dollars into U.S. Treasury securities and other American assets. This created a reliable, large-scale buyer for U.S. government debt, effectively keeping borrowing costs artificially suppressed even as the United States expanded its fiscal deficits. Washington could sustain spending levels on defense, social programs, and infrastructure that would have been unsustainable for any other country facing similar debt dynamics. because there was always a steady inflow of foreign capital ready to absorb new bond issuance. The third pillar completed the mutual bargain. In exchange for pricing oil in dollars and recycling revenues into U.S. markets, the United States committed to providing robust military protection. Advanced weapon systems, intelligence sharing, political support on the international stage, and a permanent security presence in the volatile Persian Gulf region. This security guarantee shielded the Gulf monarchies from external threats, regional rivals, and internal instability, allowing them to focus on economic development and oil production. Together, these three pillars formed an invisible but extraordinarily powerful engine that operated continuously behind the scenes of every global financial transaction. Following the collapse of the Bretton Woods system in 1971, when President Nixon ended the dollar's direct convertibility into gold, this petrodollar mechanism effectively provided a new anchor for the floating dollar. It transformed the currency into the undisputed world reserve, facilitating smoother international trade, deeper liquidity in U.S. markets, and unparalleled geopolitical leverage through sanctions and payment systems. The arrangement contributed enormously to what has been called the American financial dominance, saving the U.S. economy hundreds of billions in reduced interest expenses annually and allowing persistent current account deficits without the punishing crises that have historically afflicted nations attempting similar policies. For half a century, this system functioned with remarkable stability because it aligned the incentives of producers seeking security with those of the U.S. seeking monetary hegemony. It was not mere background noise in financial markets, it was the foundational architecture enabling the dollar's supremacy. However, today this long-standing engine is experiencing multiple simultaneous fractures that are eroding its effectiveness from several directions at once. The UAE's departure from OPEC represents the first major visible crack. The Emirates have poured enormous capital into expanding their oil production infrastructure, developing advanced fields, enhanced recovery technologies, and export facilities capable of sustaining output near 5 million barrels per day. Yet OPEC's quota allocations consistently restricted them to roughly 3 to 3.5 million barrels, meaning the country was operating well below its efficient capacity, like running a high-performance factory at only 60% utilization. This constraint grew increasingly frustrating and economically irrational as the UAE pursued ambitious diversification under its Vision 2031 plan, investing in tourism, finance, aviation, renewables, and technology to reduce long-term hydrocarbon dependence. Beyond quotas, the UAE's formal joining of the BRICS alliance in 2024 aligned it with a group of nations actively building alternative trade mechanisms, payment systems, currency swap lines, and clearing arrangements designed to gradually lessen reliance on dollar intermediation. With China emerging as the UAE's largest individual oil customer, the practical logic of invoicing sales in Chinese renminbi becomes compelling. It reduces foreign exchange risks, lowers transaction costs associated with dollar conversion, and streamlines massive bilateral trade flows that now exceed $100 billion yearly. Geopolitical prudence in an unstable region further encourages this diversification, protecting against potential payment disruptions or sanctions-related complications. India has already successfully conducted rupee-denominated oil purchases from the UAE, proving that such non-dollar settlements are not theoretical but operationally viable. The second critical fracture targets the very heart of the petrodollar system, Saudi Arabia itself, the pivotal player whose 1974 cooperation with Kissinger established the arrangement. Riyadh is now engaged in serious structured negotiations with Beijing for multi-year, even decade-long oil supply contracts that could be priced and settled in renminbi. These talks go well beyond preliminary discussions and reflect China's massive daily imports of Saudi crude. If concluded, such agreements would directly undermine the dollar's exclusive pricing role at the source of global supply. Parallel developments reinforce the pattern. Russia, cut off from full dollar access due to Western sanctions following the 2022 Ukraine conflict, has routinized energy trade with China, India, and others using local currencies for over 2 years, bypassing traditional SWIFT channels and dollar clearinghouses. India continues expanding rupee-based oil deals, while countries like Brazil and others experiment with bilateral barter or alternative currency mechanisms. These shifts are not random or coincidental. They stem from rational, self-interested calculations by sovereign nations seeking to minimize exposure to a currency whose reserves can be frozen at political discretion, as demonstrated vividly when Western authorities immobilized approximately $300 billion in Russian central bank assets, That single event triggered a worldwide reassessment among finance ministries and central banks. Remains clear and concerning. Meanwhile, America's national debt continues climbing rapidly, with annual additions in the trillions and interest payments now rivaling or exceeding major budgetary items like defense. In such an environment, any softening in foreign demand for treasuries raises the prospect of higher yields, greater reliance on domestic monetization by the Federal Reserve, or accelerated inflationary pressures as the only politically feasible paths to manage the arithmetic. All these fractures converge powerfully on gold as the preferred alternative asset for reserve managers worldwide. In recent years, central banks have collectively purchased gold at rates not witnessed since the aftermath of the Bretton Woods breakdown. Countries spanning vastly different political systems and economic stages, Poland adding substantial tonnage year after year, China steadily building its holdings, India diversifying reserves, Kazakhstan, Brazil, Turkey, Uzbekistan, and many others are converging on the same strategic decision. This accumulation is not driven by short-term speculation or emotional fear of immediate crises. It constitutes a deliberate, long-horizon institutional strategy by entities with the deepest expertise in monetary history and systemic risk. After observing the Russian reserves episode, every responsible reserve manager asks the same fundamental question. Are our foreign currency holdings truly ours if they reside in a system ultimately controlled by a potential geopolitical adversary? Gold held in domestic vaults or secure neutral locations provides a fundamentally different answer. It cannot be frozen, sanctioned, or erased by digital instructions to correspondent banks. It carries no issuer risk, no counterparty obligation, and no national affiliation. For over 5,000 years across the rise and fall of empires, civilizations, and every form of paper currency experiment, gold has reliably served as a store of value precisely because of these immutable properties. Its above-ground stock grows slowly, only 1 to 2% annually through mining, with no ability for any central bank or government to expand supply via policy decree. A common misunderstanding among retail investors concerns the mechanics of gold's price movements. Gold does not primarily rally on geopolitical fear alone. During acute crises, several countervailing forces often suppress its price temporarily. The US dollar strengthens as a global liquidity haven. Real yields may rise as policymakers hesitate on rate cuts. Unleveraged positions in futures or ETFs face margin calls that force selling. These dynamics are mechanical and short-lived. Once deleveraging runs its course, gold reverts to reflecting the deeper structural drivers, accelerating de-dollarization trends, ongoing debasement of fiat currencies through relentless monetary expansion and deficit financing, and the need for genuine portfolio diversification in an increasingly fragmented geopolitical landscape. The U.S. has added trillions to its debt in recent years alone, with interest obligations creating a self-reinforcing cycle that tilts toward inflation as the path of least resistance. Gold's inherent scarcity stands in stark contrast. Historically, an ounce of gold bought a high-quality Roman toga or equivalent goods 2,000 years ago and retains similar purchasing power today, while the U.S. dollar has lost more than 95% of its value in real terms since the early 1970s. Debasement represents one of the most powerful long-term tailwinds. Fiat money systems depend on public trust in central banks and governments, yet continuous expansion of money supply through quantitative easing, stimulus programs, and deficit monetization inevitably erodes that purchasing power over time. In a world where fiscal necessities increasingly dictate monetary policy, gold's inability to be printed or inflated away becomes a decisive advantage. Diversification provides yet another layer of rationale. With European nations rearming, Asian supply chains being reconfigured for resilience, and long-standing trade relationships renegotiated under security pressures, overconcentration in any single currency bloc or financial system carries elevated risks. Gold offers neutral, apolitical ballast that remains independent of these evolving political and alliance dynamics. From an investment perspective, these developments open clear pathways while demanding careful risk calibration. Physical gold bullion or shares in unleveraged exchange-traded funds provide the purest, most direct exposure to the de-dollarization, debasement, and diversification themes. While such holdings do not generate yield or compound internally, they have historically excelled at preserving real wealth during monetary regime shifts and periods of currency instability. Gold mining companies, on the other hand, deliver leveraged participation in the same thesis. When the gold price rises meaningfully, miners benefit from expanding profit margins because a large portion of their costs, labor, energy, equipment maintenance are relatively fixed in the short to medium term. This operational leverage has enabled quality mining equities to deliver outsized returns during past sustained gold bull markets, particularly those with disciplined management, low all-in sustaining costs, strong balance sheets, and projects in stable jurisdictions. However, investors must account for additional risks including operational challenges, regulatory hurdles, energy price volatility, and environmental considerations that do not affect